Welcome to the 4 Wise Monkeys, the best shares and investment advice on the web. Our 4 monkeys providing the wisdom this week are none other than David Stevenson from the Financial Times, Stephen Barber from Self-Trade, pro-share investor Paul Dolman-Darrell, and the naked trader Robbie Burns. And your host today is Ryan Dean. Hello and welcome to the show. How to make money in such troubling times? A tricky question that our monkeys hope to answer today. Is it in gold or is it in energy? Hopefully by the end of the show, we'll know.
Plenty of oil companies around at the moment that are going up, and I'm in many of them. My favourite in the sector must be Petroleum. Prices already nearly doubled, but I think there's another £4 or £5 in it. Every time the share price starts to go down a little bit, up comes a statement saying they've found more oil. They recently found some more oil in Egypt. Just the sort of oil company you want to be into, and I really like the look of this. Another company I like is one very hard to say, so I'll try and say it, PV Crystalox. I haven't had anything to drink today, so that's helped a bit. But what it does is it supplies solar wafers. It's a great new technology, it's a great growing technology. It's a fairly new company, it's only been on the market about a year, prices already shot up. And I think there's a potential for another £1 in this share price. Not been on the market for long either, so I think people will gradually get to know it and should help the share price go even further.
Now it's time to find out what's getting the monkeys in the studio excited. Okay guys, we're 1 monkey down this week, so your suggestions better be pretty good. Paul, you're up first. What have you got for us?
Yeah, Aviva is my tip this week. You might previously have known them as Norwich Union. Insurance company, again, this is a classic value play for me. I've been looking at all of the FTSE 100 companies, trying to find a company with a great dividend yield who can actually afford to pay it.
David, why is this so cheap to start with?
Because it sort of takes people like my granny's money and it sticks them in really horrible, nasty things like shares and bonds, and that's what it's supposed to do. But the problem is if we do that at the moment, guess what? It's a financial services company that gets hammered, along with the banks, although I think it's a better bet than the banks.
You know, the downside for me is the shares could easily go to their 2003 lows, which is around the £3, £3.50 mark. What we were talking about possibly as a suggestion is that you drip into this one rather than making it a solid straight out investment.
Now, David, your suggestions are often quite kooky and quite pessimistic. Please tell me that isn't the case today.
It's deeply negative and deeply kooky. This is something called, it's another covered warrant. It's called ST41, sounds a bit like a transmitted sexual disease. And basically what it is that it makes you loads of money if you think that the gold price is going to suddenly shoot up. And if gold suddenly shoots up because hell breaks loose, the Iranians start getting bombed by the Israelis, oil hits $200, you could see massive volatility. Stock markets crash down to, FTSE could be 3,500, yeah? Gold could suddenly double, quadruple, triple in price. As soon as it starts heading past $1,500 an ounce for gold, you'll make 4, 5, 6 times the amount of money you put in. So it's a tiny insurance policy on my portfolio, and I personally think it won't happen. You know, I'll be honest, and that's why I've only put 1% in.
Paul, 1% of your portfolio, I mean, really, is it worth it?
No. And the reality is that genuinely the markets could go lower. This may well make money. But for me, I think really the great opportunities now are to start looking at upward buys, not downward buys.
Right guys, before we go, we're over halfway through the year. The market has taken an absolute hammering. How have your portfolios performed? Paul, you're up first.
I roughly already know his answer, but you know, my answer is I am down, but not anywhere near the market. We're a good 20% now, official bear market below. I think I'm about 2-3% down on my portfolio. It was Warren Buffett who wisely said once that he'd rather outperform the market while it's falling rather than outperform the market while it's rising. That's what I'm doing.
So, okay, we've got Warren Buffett over here. David, you're looking a little bit more smug. How's your portfolio performed?
This year, I'm stable, steady. But I will admit that the second half of last year, I probably took about 7 or 8% loss because I basically did start investing in some blue chips because I thought they were at a decent price and I got hammered. But ever since then, I've switched to a much more bearish, much short-based strategy and I'm not doing badly.
Right, guys, thanks for being so honest. We'll see you next week. We catch up with Stephen Barber to find out why he's interested in energy in emerging markets.
The energy fields tend to be under the sea, so they're difficult to find, they're difficult to remove the energy. but the rewards that come with that are much, much larger. Well, there's a whole range of companies that are involved in energy exploration in these emerging markets, and if you pick the right one, it's going to do very well indeed. Obviously, these are engaged in high-risk, high-reward activities. There's also the countries themselves, and these are emerging markets which will benefit from energy exploration. So if you're investing in emerging market funds or emerging market trackers through ETFs, they will benefit when energy is discovered.
Remember to check out the website 4wm.co.uk for more information on all the ideas discussed today. See you next time.